Finally, students, we come to owner's equity. So we did valuation of liabilities. We did deferred taxes and leases, which may be asset or liability. And now we have come to the remaining item on the liability side of the balance sheet. Actually, we have finished valuation of assets. So we have actually come to the remaining item, the last item on the balance sheet, the owner's equity. So what is the owner's equity? A business owns. What a business owns is assets. What a business owes is liability. And what is the difference? The difference, the residual amount, that is owner's equity. So what is owner's equity? Assets minus liabilities is equal to owner's equity. It is nothing but the balancing figure in the balance sheet, the residual figure, the residual amount which belongs to the owners. Irrespective of the form of business organization, you may have a single person who is doing a business. So for him, assets minus liabilities belongs to him. You may have a group of people doing a business, something like a partnership. Assets minus liabilities, what remains belongs to all the partners. What each partner's share is could be different. Similarly, in a corporate form of organization also, assets minus liabilities, the remaining amount is owner's equity. It belongs to all the shareholders of the particular corporation, particular company. Okay, what it consists of, we will discuss. But owner's equity, remember, is nothing but assets minus liabilities, irrespective of the form of business. So now let us come to a shareholder's equity, which is nothing but we are talking of the company form of business. What happens? What is shareholder's equity, owner's equity? If we take, it consists of two things. One is capital and one is retained earnings. These are the main components of shareholders' equity. Let us understand them. What is contributed capital? As the name suggests, contributed capital is the capital which is contributed by the owners, right? So that is contributed capital. But again, it consists of two things: capital stock and additional paid in capital. What is this, students? You must understand, I don't know, if suppose you take a company's capital, let us assume consists of just $1 million. We are taking smaller figures for ease. $1 million. Okay, this $1 million is not held by one person but several thousands of people. So this 1 million is split into different shares. Let us say it consists of shares of $1 each. $1 each. Do you understand? So I may hold 10 shares, you may hold 50 shares, somebody may hold 500 shares, another person may hold 1000 shares, and so on and so forth. So if I hold one share, I have just $1 worth of capital in this. If I hold 10 shares, I have $10 worth of capital. Do you understand? So in a corporate form of business, you have several owners, a lot of owners. Each of them have some share in the capital. This capital is called share capital. Each one has a share. It depends. Somebody may hold 500 shares, somebody may hold 1000 shares, etc., etc. Is it clear? So now this $1 each, right? Now, when a company issues this capital, it is quite possible that this $1 share, it actually issues for $5. And it says, yes, my value, this value is called the face value. The face value. It may be called the registered value. So mostly shares have a face value. It may be a $1, it may be $2, it may be $5, it may be $10. Okay, that is the face value of a share, and the capital stock is recorded at this face value. That means if I hold one share, each share into 1, since face value is 1 per share, it is recorded against the item called capital stock. Okay, that is called the face value. But like I said, the company may issue this share for $5. In that case, this $5 consists of $1, which is called capital stock, and $4, which is nothing but it is called additional paid in capital. It is called additional paid in capital. So capital stock is the face value, and this amount, this is additional paid in capital, or we call premium. It's issued at a premium. Is it clear? Is it clear? So contributed capital together, this is the total amount. We have contributed $5 to the share, $1 is the capital stock, and $4 is the additional paid in capital. Clear? So this is capital, this is contributed by the owners, and on the other side you have retained earnings. What is retained earnings? It's nothing but undistributed profits. The profits that you have made, it's accumulated profits, profits that you have accumulated over the past several years. All this belongs to whom? It belongs to the owners. When you make profit, it is not necessary. A company particularly, when it is trying to grow, does not distribute all the profits that it has. When it makes profits, it retains the cash with it so that it can be used for further growth, for further expansion. Is it clear? But actually this belongs, if tomorrow the company is to be liquidated, the assets, we will liquidate or sell the assets, get the money, pay all our outside liabilities, and the balance figure will go to the shareholders. So these undistributed profits actually belong to the owners, actually belong to the shareholders or the owners. So the shareholders' equity in a company form of business consists of contributed capital and retained earnings. Contributed capital may have something called the face value and the premium, the capital stock, and the additional paid in capital. Any amount paid above the face value to the company is called additional paid in capital.